Hi guys, welcome to Blockchain Live. We're actually coming live from blockchain, concrete blockchain, like out here at 20 Queen Street in Melbourne. So don't forget to come down, and if you want to learn about blockchain and the cryptocurrency and how it can help you in the future, especially trying to understand what cryptocurrency is all about, and come and meet the real owner and learn more about blockchain technology and also concrete. So we're going to start in the next probably 6:45, probably about half an hour. Hi Nicole, thanks for watching. So don't forget to share, and if you can't make it today, that's fine. We're going to record this live. So this is a pre-bar, so come and join us. We're going to start next, I think 30 minutes, 6:45. And this is where we are, 20 Queen Street in Melbourne. So we've got people coming in now, and we look forward to getting started soon and learn more about concrete blockchain and how it can help us in terms of real estate industry and how it's going to change the world in terms of digital currency. Okay, thanks. Bye for now. See you shortly, guys. Hi guys, listen up.
You're at the front. One thing I've learned, you want it all happen.
Close to the action.
That's exactly it, mate.
Let me grab my rush.
Speak.
Yeah, that's so much. Do you want to stand answer? Alrighty, welcome everybody. Thanks for giving up some time on your Wednesday night to join us here at Collective Campus. I'm Sean, this is Moresh. If you haven't been able to tell yet, we're from Concrete. And tonight we'd like to have a conversation around what we think is super interesting, and hopefully after tonight you'll think the same, and that is the intersection between blockchain technology and real estate. It'd be great to get a sense of the room so we can sort of cater to who we're talking to. How many people are involved in property development, let's say? A couple of hands. What about just general investing in property? Yeah, a few more. What about blockchain, cryptocurrency? Yeah, cool, a few people in the space, awesome. So hopefully a lot of the things that I'll say won't be completely but I'll try to tailor it as we go along. So us Aussies, we love our real estate. This is how much money we have in Australian residential stock alone. That is nearly 6 times our country's GDP. We love it. Everybody talks about it. You can't go to dinner with family or friends without property coming up. But there's a problem. I'll tell you why. It's taking so long for the average Australian to save up for a home deposit. In Melbourne, it's creeping up towards 7 years for an average wage, and in Sydney, it's over 8 years. I mean, as young people, millennials start to buy houses, their lifestyles are starting to further reflect that they want to travel, do other things, and this problem is just going to get larger and larger. On the flip side, we've got people sitting on houses that they've already paid off. They're retired, they have no income. What happens then if they want to access the equity in their property, get some cash? They have to sell their houses, they have to go back to the bank, take on more debt. It's not ideal. And that's even if the banks lend to them. So we came up with a marketplace solution where people could invest in someone's deposit. And on the flip side, they would then be able to enter the property market sooner. This sounds good, but will it actually work? Will people actually get a return? You might be asking, you've heard of some fractional property things out there in the market already. You know, it's not a revolutionary to be able to invest in property with, let's say, $100 or $200. That's true, but we think they only go so far in terms of addressing the core problem. No one's losing sleep because they can't invest $100 into real estate. Someone's losing sleep because they can't buy their house, and someone else is losing sleep because they can't release equity from their property. You had something to add around fractional property things?
Yeah, so there are a few fractional property platforms out here, but the most successful ones are really pushing their own property. They are not really promoting their own, they are not really an open platform. What they are really doing is they are owning the property and then they are offloading it to retail investors at a higher price. So at that point, they are really making their own margin rather than being of benefit to small investors. The other big issue is even if you had a platform which, let's say, allowed people to propose their own property to release equity from it, the issue with most of them, and this is a little bit technical, is they own the property in a trust, and then they sell units in those trusts. Okay? Now there are a few different issues, but I'll touch on a couple of big ones. The first one is if you already own the property, then you would have to transfer the title of the property to that trust. Now that means that there's a stamp duty event, there's a CGT event, you won't get first owners grants, stamp duty concessions, CGT exemptions, etc. And who in the right mind is going to first transfer title to a trust owned by somebody else in order to access some wealth for it? And the second bigger issue, which if you think about it, is property as an investment is interesting primarily because of leverage. Okay? So people invest in property with, let's say, 10-20% of the required amounts, and then they borrow the rest. And as hopefully the property prices grow, then you get a leverage return. Without leverage return, property as an investment, direct investment, is not really interesting. So the issue with a lot of these platforms is because they own the property in a trust, they don't allow, they don't really borrow against it, and if the borrowing is there, then the LVRs are low and then it is limited recourse borrowing. The effect which you get by investing in property in a leverage manner is not there. So we believe that we have addressed some of the concerns in existing platforms, but we'll go into the detail later on.
So accessibility, that's a big thing, and that's already been addressed by some existing platforms. Democratization of investment into property is important, and that's something that we will have. But liquidity is something that they don't have, and that's only possible by the blockchain, and we'll go into that a bit more later on. Leverage, as Maresh has mentioned, by implementing this option structure, we're able to provide our investors with leverage without taking on additional debt themselves. And you can do good. You can help somebody get into that house sooner. It's a young Australian into the house, and also it's a great investment opportunity. So how do we achieve this? One word, blockchain. Show of hands who've heard blockchain before. Most people in the room, I'm sure. What about those who actually understand how it works? A few more? Fantastic. Can anyone guess where we're going to go with this? So, good mate. Don Tapscott, which, by the way, if you haven't checked out Future Squared, my co-founder over there, Steve, has interviewed Alex as part of the blockchain revolution. It's, in the most simple terms, a ledger that everyone has a copy of, and it's constantly updated. There is no central point of failure. Now, that in itself doesn't sound too interesting, but once you start to think about the implications of what that means in our world where everything is connected online, it starts to get very interesting. The three main reasons we're interested in blockchain and how we're going to utilize it to achieve our vision is centralization across all nodes, like I mentioned earlier. The truth, it's updated on everyone's ledger. No one can fake the fact that they own a particular share of this particular property because everyone has a copy of that. And smart contracts. For example, if I need to make a vote on the platform, I don't have to send my vote to someone who then manually checks it and then checks it against certain criteria before issuing it. Weeks later, I might get that share registry. This is something that can be executed automatically if the criteria is met. Do you want to talk about this?
Yeah. So what we are doing with Concrete is, what the fundamental thing is, we are going to set up and manage investment scheme for those who are in the know over here. And that will be serving as the mechanism in which people will be investing. But beyond that, what we are really focused on doing at Concrete is building the underlying infrastructure. So what we are really going to do is build what can be called as the a bit analogous to the ASX of blockchain. And that would mean that it's not just our offer for fractional property which can leverage the underlying infrastructure, but other issuers, other people who want to raise money for their businesses, for their development projects, or even competitive products which are in the fractional property space. They should be able to use the infrastructure which we are building as part of this and then achieve their own goals. And tomorrow, if somebody comes up with a better flavor of fractional property to help people get into the property market, they should be able to achieve their goals using the systems we build. And we'll be okay with it because our objective is to have the best outcomes for people who want to participate in this, and also the fact that we'll still make fees as the platform operator. Okay. So what we are really building is really this bit. Okay. So this is a distributed ledger which will record all the shares or units in various different investment offerings. So this is what is the fractional property fund, which basically will allow people to crowdfund their deposits or release equity. Beyond that, property developers who want to raise money for the development project will also be able to access investors using this backend distributed registry. And one of the things which we'll also get into detail later on is because we are using this blockchain distributed registry, any offer is implicitly liquid. Okay? Because as Sean explained earlier, there is no central point. You don't need to go to a central party to exchange your units. You can exchange your shares in a peer-to-peer manner, which means that it is really a bit of a poor man's ASX, if that's the term. What that really means is, once you have liquidity, you will be able to access capital at a lower cost, and the investors will also have an exit mechanism faster than completing the project. So it's not just the fractional property fund. This underlying infrastructure can support property development offers or any other business-related offerings from third parties.
So bringing it back to blockchain, distributed governance for us to see exactly when and how someone has voted on a particular thing. Investor reach, as we mentioned earlier, potentially the global market is now available for our investors, and liquidity, your tokens can be traded.
I talk about this a little bit. See, what we mean by distributed governance is we are not setting out to be fund managers over here. What we really want to do is we want to build the mechanisms, the infrastructure by which people can achieve their goals. So the way we are going to set up the fractional fund is the way a particular property is chosen for acquisition by the fund is going to be based upon voting of investors. So just like you have AGMs or shareholder meetings, this will be much more real-time, and at a much higher frequency, which means that the decision of which property is acquired by the fund is going to be based upon the investors, and anybody who wants to crowdfund their property will have the same chance, depending upon the merits of the property, of course, as anybody else. So what it also means is, even us, as the people who are behind this, will not have an advantage over anybody else. So that is meant by distributed governance. Investor reach, see, once you are putting a once you're using the distributed registry, you are able to reach a much wider audience because there are people worldwide who are in the crypto space. by putting shares by what are essentially security tokens, issuing them as security tokens, you can achieve a much wider distribution. And once you have much wider distribution, and the fact that they are on a distributed registry means that these shares are inherently liquid. Okay, so how will concrete make money? So I like to envision concrete as a highway network. Okay, so just like once you have the highway network, there are cars running past it, and people may want to go from point A, point B to C, C to D, and many different people are going from different places. And what we are really doing is we are building this roadway, and then we will be taking a toll of it. Okay? So people can do whatever they want in terms of raising capital. People can then change things to each other, and we'll be taking a clip of it. But where it becomes very interesting is roadways have physical limitations. I mean, there are only so many cars which can go at one point on this roadway. But once the distributed registry is built and the underlying software is built, it really doesn't have those limitations, the physical limitations. The scope or the scale at which we can go is really, really exponential. So where we are going to make money is primarily administering boards. So people, when they are doing the decision making, shareholder voting. Second, market transactions, when people want to exchange their shares, providing updates to investors, and obviously raising capital and listing for various offers on the network.
So we're talking about the platform, and just bringing it back to some actual real-world case studies. We'll talk about the fractional fund, which is one of the things that will sit on the platform. Take Jimmy, for example. He's 30 years old, he has a good job, but he's just spent 6 months in Ibiza, and he doesn't have a lot of money in his bank account. He's got 10%, but his bank has come back and said, look, mate, you need 20. So what does he do? He meets up with his real estate agent or buyer's advocate, who happens to have the perfect property for him. It's a little bit out of his price range, but they can make it work. And he says, you know what, Jimmy, you can get a loan, and I've got a way for you to get the rest of the money. Check out concrete. So Jimmy really likes the concept, and he applies to concrete with his property, with all the other information that we'll ask for, to present it to the fractional fund. Our investors on the fractional fund assess the application, and based on all the information that they have, they make a collective vote as to whether or not the fund will invest in Jimmy's 10% of his property. Once they do that, the vote is cast, and the fund, via its smart contract, automatically releases the funds for an option on Jimmy's property. Investors in the fund, again, because it's fully liquid, can start trading their positions instantly. They don't have to wait for Jimmy's house to go up in value. They can take it out, they can swap it, they can peer-to-peer trade to their house container.
Yeah, so just like this fractional fund, we use the underlying concrete distributed registry. We at Estate Baron, what we do, I mean, I run a company called Estate Baron, and we help property developers raise money for their development projects. And just like the fractional fund can use the underlying concrete distributed registry to reach investors and give them liquidity, other investment offerings such as property development ventures can also use this network of investors to raise money for their development projects. And also, if anybody has a different business concept, then you can still use the network. So it's fundamentally a mechanism to do an IPO, but at a much lower cost than what you would typically require, and with a much lower compliance/administrative burden as you would have when you would go and list on the ASX. So I run a company called Estate Baron, and I was fortunate enough to be selected in the PropTech Accelerator sponsored by Charter Hall, which was run by Collective Campus. We have been around for 3.5 years. We have assisted more than 15 deals dating, and we have more than 3,000 investors, have raised more than 12 million for various development projects, and our property developers, through their own networks, have raised more than $40 million for their development projects. Typically, we do equity funding, we don't do senior, but technically the structures which we have are really done as a prospectus as an IPO, which means they can be leveraged for anything you really want.
So the other half of Concrete is Collective Campus. We're a corporate accelerator, and we've run A lot of first accelerators in Australia, including the first legal tech accelerator in Australia, the first VR and AR accelerator in Australia, and of course the first property tech accelerator in Australia with Charter Hall, which is a big Sydney-based REIT with around $25 billion under management. These are some of our corporate clients, and these are some of the startups we have incubated or call as part of our community. You might have seen Horizon State, they're a very prominent blockchain startup. Of course, our accelerators, and if you watch Shark Tank, you would have seen Bricks and Agent get some funding from Steve Baxter recently as well. We've put a great team around us because we're big believers that the success of your company revolves around your team. Our team comprises of management from both Estate Baron and Collective Campus, but also a great network of advisors from property, finance, blockchain, and legals, of course, for our partners at Cornwalls. Here are some milestones that we have. Coincidentally, both our companies were founded in 2014. This year, Moresh wrote the white paper for Concrete, and we have a share sale coming up soon, which we'll talk about a little bit later. The platform will be launched by mid-2019, and by 2022 we envision that the security token as part of the fractional fund could form a stable coin that's backed by real estate. So how can you get involved? Firstly, thanks for coming, you're already here, you're part of the journey. We're doing an ISO, which is something we kind of made up because it's not an ICO. ICOs, as you know, are getting a lot of scrutiny in the market, and we want to be in front of compliance as much as possible, because ultimately what we're doing revolves very heavily around making sure we're getting along with the powers that be. We're selling shares in the company, preference shares, and the most we'll ever issue is 100 million preference shares in Concrete, as well as 100 million Concrete tokens. That's the current price. We have a wholesale IM available now by expressions of interest. So if you go to concrete.io, you can leave your details and we can send you that IM. But for everyone else, it's not just about the fundraise for us, it's about building the community of people who believe in what we're doing and want to find ways to get involved. Of course, you can register your details on Concrete to stay abreast of our journey. We'll also be offering the first 100 people to register their official accounts with us some complimentary Concrete tokens, and of course you can join our Slack group as well down there to be part of the conversation. Thank you. Before we wrap up, obviously we'd like to open up for a few questions around the platform that we're building. Feel free to ask away. Yeah.
Well, back to that Jimmy example.
Yeah.
So I felt like you did get to the end of that story. You said about crowdfunding is deposit. What happens then, basically, from, I guess, a legal perspective? Is there an encumbrance there? How does that all work after
I'll talk about
successfully being selected?
Yeah, so the way, and I can only go into so much detail because we'll have to.
Okay, but dollar for dollar is what the preference share is.
Right. And out of the four means of profit or continual profitability of the company, would you say that the fee raising and from the way that I'm looking, it's far to the right, far to your left, would that be the mainstay, the ongoing profitability of the business?
So,
and if it wasn't, what would be?
Yeah, so the biggest revenue source in the very long run will be secondary market transactions and raising fees. So it's not just fractional fund. Other people will also list, will be charging raising fees, cap raising fees for them, as well as when their offers are on the platform and somebody trades their shares, then we'll be capturing the spread on that transaction.
So perhaps the spread would be where the majority of the profitability comes from, rather than the initial listing and raising fees.
See, initially, obviously, the spread is a function of the secondary volume, and then it's a timing question.
ISL spread.
Yeah. So the secondary market transaction volume will build over a period of time. So in the first few years, I would think that the primary revenue will be cap raising fees plus any other voting or structural things which we make. But in the long run, it will be secondary market transactions. And what we are really doing is, to some extent, we are eating our own dog food, where we have one issue, one security we are setting up, which is a fractional property fund, which will use the underlying platform. And we are sort of creating an ideal case of how securities should behave on the blockchain, because we are decentralizing its governance and also using the underlying blockchain network for achieving liquidity. But that use case can then be copied by other security issuers to structure their own investment offerings as a best practice for security tokens of the blockchain.
And maintain liquidity.
Right.
Gotcha.
Personally, I think this is how finance will look like in the long run, because you are giving liquidity and distribution to start with. So, rather than we put for that.
So once the coins go live, you'll have your own private exchange, or will you be listing, or I guess the goal would eventually be listing the coins on a global.
The goal will be to eventually list those. So there are two kinds of coins that we're talking about. The coins we're talking about right now, the tokens, are the utility tokens that power the infrastructure of Concrete. In terms of the fractional fund, for example, the security tokens, and that'll be a separate token to what we're discussing tonight. Our utility token, the vision is for that to be listed on public exchanges. Yeah.
So the purpose, I'll talk about the purpose of the utility token a bit. The utility token will be used primarily for people who want to list on the platform, pay for transaction fees, use as a mechanism to vote on the platform. And the security tokens are really shares or units in various different investment offerings.
When an investor comes in, he buys the preferred shares at all, and he receives a token free of charge.
Okay.
So implicitly, the token is not value.
As a start, to be honest, no tokens have value because unless the network is getting built,
Then the
it doesn't
second
carry
part of the
value.
question is the tokens can be sold independent of the preferred shares.
Correct.
So what are the economic forces that will drive up token value?
Okay, I can talk about that a little bit without going into a lot of detail, primarily because we will be entering a little bit dangerous territory about talking about returns on tokens. But I can talk about the use cases for tokens. So initially, of course, when a lot of people do token sales, it's a little bit of a vaporware because tokens really carry no value unless the network is built. Because if the purpose of the tokens is to be used for something, the underlying structure should be there. But the tokens will be used for listing fees, voting mechanisms, secondary market transaction fees. And as far as the economic forces, as part of our token economics, what we are doing is, number one, we have limited supply of the number of tokens, but also what we are doing is, for every transaction that happens, we are going to burn a percentage of the tokens, which will make the tokens scarcer over a period of time, which means that in order for somebody to do what they want to do on the network, they need to have those tokens which are in limited supply, which hopefully should reflect in the pricing of the token.
And we've got a formula outlined in the white paper as well, which has a deeper explanation of how the burning mechanism will work.
Yeah. And also, the way I look at things is, we want the token to be a fuel. We don't, as a mechanism to enable transactions on the system. We don't want it to be an asset by itself. We want it to be a currency, which means that we actually do not want the price to be extremely volatile. We want early token holders to make some gains because they are backing us. But in the long run, we are actually we are structuring things so that yes, we will achieve growth on token value, but we don't want hyper volatility. So there are some structural things which we have incorporated as part of the token economics, which should address that.
So ultimately, your ecosystem will have 100 million coins, right? So
Right.
because you mentioned you're looking at doing the burning, whatever.
Yeah.
So if you're burning, does that mean it reduces the number
Correct.
of coins? Or
Yeah.
okay.
So that's the total number of tokens.
Yeah.
100 million. We are going to start with 3 million plus 10 million.
Yeah.
And as part of the burn rate, a maximum of 20 million tokens will be burned.
Okay.
So the
Because they're tokens, they're not actually the coin itself. Is that right? Or,
So these are the utility
The
tokens,
utility
not the
tokens.
security tokens.
yeah,
Okay.
yes, so 20 million tokens are going to be burned through the life of this project. So the maximum supply you will ever have is 80 million. But we are not going to issue all the tokens at one shot after this 13 million issue. We are going to only issue tokens when we think the price has gone beyond a certain point and we want to put some downward pressure, because we don't want, see, the purpose of the tokens is to drive transactions. So we have a formula in there which says that if it goes beyond 20% annualized, then we'll release some tokens to sort of push it down a little bit. So there are two counteracting forces. One is the burning of the tokens, which will push up the price, and then there's the long-term supply, which will sort of make sure that the tokens don't really fluctuate too much.
Hi, I had a question about the ISO. I'm familiar with the term IPO, the initial public offering. A couple of questions around that. So, where is this company incorporated, and is there some prospectus attached to this ISO?
Yeah.
Could you explain what ISO means? And
That's a made up, it's a sexy made up marketing term, but it's more or less an IPO.
It's
just help me understand what is ISO. So that's one question.
Yeah.
The second question is around the incorporation. So obviously, any time you ask people to invest, a couple of things I would have thought they'd be interested in is what is the growth profile of their investment, right? The blue sky in the future. You obviously don't want to lose money, right? That's probably not a good plan. But secondly, and almost equally importantly nowadays, what is the tax treatment of that investment, right? So, with respect to, say, borrowing for investment property, for instance, right? So, as you're aware, quite attractive in Australia at the moment is the concept of negative gearing, right? So, how does that play out in the Australian environment? Can I use some of this borrowing to offset against, the tax payments, etc.? So, could you please explain those two answers?
I'll talk a little bit and then you can jump in. So I'll talk about, because I'll talk the last questions first. I talk about the tax things a little bit. I'm not a tax advisor, so do your own diligence, but I can give you a high level picture and you should verify this with your tax advisors. So as far as investing in this company is concerned, they are pref shares, okay? But we believe, and this will be detailed in the, for wholesale investors it will be an IM. We are incorporated in Australia, in Victoria, and it's a public company, and we will be issuing what is called as an
Incorporated in Victoria.
Incorporated in Victoria.
Right.
Okay. It's a public company, and we are going to issue what is called as an offer information statement. It's a bit like a prospectus, but it's like a lower version of a prospectus, which limits the maximum you can raise to 10 million, but it carries the same ability to promote openly and onboard retail investors, just like a prospectus would. We have, as part of my dealings at State Barron, we do prospectuses quite regularly. So we are fairly conversant with that structures. But with this thing, we didn't really believe that prospectus was required, and we are doing a wise over here. But it achieves the same goals, limited to 10 million. As far as tax benefits are concerned,
Sorry, just on that question.
Yeah.
The minute you say you incorporate Victoria,
Yeah.
ASIC will be right across. You won't be able to raise any funds unless you have some sort of perspective, right?
Correct. Yeah.
Right?
So for wholesale investors, we are issuing an IM first,
Yeah, okay.
and then when we are opening it up to retail investors, we'll have an OIS.
Right.
Yeah, so
there
again,
will be some
right now it's expressions
Of course,
of
yeah.
interest.
Blue sky growth, there's some revenues,
Yeah.
asset backing, all that kind of
That would be the OIS.
Okay.
Yeah, that will be the IM first, and then
Okay.
the OIS. Now, as far as tax benefits are concerned, again, talk to a tax advisor, but we will likely be set up as an early stage innovation company, so there are some tax benefits over there. Plus, we are thinking that this will be frank dividends. So if you have any benefits of achieving frank dividends as an SMSF investor in the company itself, the online platform itself, there are some things for you to consider over there. Now, as far as the fractional fund is concerned, investing in that's a little bit too early, but I can talk about negative gearing just a little bit. The person who owns the property, he will be able to borrow it from the bank, and if he is using it as an investment property, then the same rules will more or less apply. So any difference which you have between what you pay for your mortgage versus what you make as rent, you will still be able to claim for negative gearing over there. Does that answer your question?
Yeah, no, it does actually. Thank you very much.
Yeah.
I was interested also in that use case. You know, where you said you lent, if I understand, someone a certain amount of money, right? And was that a secured loan or unsecured loan?
So number one, so that is where I'm sort of trying a bit hesitant to go into a lot of detail, because we are currently figuring out whether it will be structured as debt or whether it's an equity release product. But what we are really doing is it gives us the right to a share of the property's capital gain in the future. So, but we are not on the title. We are sort of debating whether it will be a second mortgage position or a failure position.
Yeah, absolutely. Because how could you then make a claim on the future capital gain?
Yes.
You didn't have a caveat on the title, right?
Of course, yeah. But the question which we are currently debating is whether it's a caveat or a second mortgage or something else. So those are
Clearly, Concrete would want to have a stake in the title, I would suggest. Yeah.
so there are considerations around how that impacts liabilities of debt. If you are on title, then obviously there is a debt liability, and we want the homeowner to get leverage returns. So we are definitely saying that, okay, we are not replacing the banks over here, we're sort of going the additional money. So having said that, how does our position look like if there is borrowing? And definitely there will be borrowing from senior lender. So we want to be cognizant of that when we do any funding structures.
Yeah, look, I love the concept of blockchain and what you're trying to do here. I'm just interested now in that prospectus or the investment details.
Absolutely.
What is the blue
Yeah.
sky potential for growth?
Yeah.
If you leave your email details with us,
Very
we'll
good,
send
very
it
good
out.
concept.
Thank you so much.
Thank you, thank you.
Might have time for one more question, and then we should polish off those drinks in the back. Unless we want to do that now. Well, thanks very much for coming. Really appreciate you guys giving up your time.
She has a question.
Oh, she's got a question. Okay.
How and when preference shares will be
Current level preference shares will be
Liquid.
Yeah. So the preference shares, because we are a security token and we are building a distributed registry, we will be using our own distributed registry to list these shares. So we are not going to be on the ASX because essentially we are building a poor-man's ASX to some extent. So which means that as the network grows, as the first issuer on the platform, we will be the first ones to be liquid. And it will be a function of how many people we can attract to the platform. So as part of this, we are going to, the money which we are raising is really primarily to attract more people to participate on the network, and more people on the network, chances of liquidity increase. But in theory, the shares in the company, once they are on the distributed ledger, are liquid from that particular day.
I'll just give a quick shout out to Blockchain Live and Cameron for filming tonight. So this video will be up on our various social pages after today, so you guys can rewatch it if you like, or share it with your friends and family. But yeah, thanks again for coming.